This part, we will discuss about the objective test question. We chose 4 questions here, and we will go through another 4 questions in next part. Okay, first objective test question. Question 1. The background information here is a company whose home currency is the dollar expects to receive 500,000 pesos in 6 months' time. So the receipt in peso from a customer in a foreign country. The foreign interest rates and exchange rates are available to the company. So you are given the spot rate, the 6-month forward rate, and also the borrowing rate and deposit rate for the home country and foreign country as well. Remember 6 months time, okay? And working in the nearest $100, what are the 6-month dollar value of the expected receipt using money market hedge? So here is asking you about the money market hedge. Using the liabilities and assets matching principle, right now you will receive the foreign currency in 6 months' time. So right now you will need to borrow foreign currency. Okay, here is the peso. In 6 months' time, the rate means 4% borrowing rate, and deposit rate is 1.5% in home currency. So you will receive 500,000 peso divided by 1.04, which is you can borrow now is 480,769 now is step 1, and the step 2 is to convert this amount into the spot rate to the dollar. Using spot rate, what is the spot rate? Which is 15 peso. In other words, it is 32,051 only. So deposit this amount to earn interest in 6 months' time. So with this 32,051 times 1.015, which is 32,500. The answer is A. All right. So for this money market hedge question, the most important part is you have to understand well about steps. You just follow the steps and work it out. Okay. We try a lot of similar questions in the risk management discussion. I think right now you are familiarized with all the steps and also what need to do on it. It's not difficult and it's quite straightforward, but you have to understand or you have to clear about the steps well before you answer it. Next, we move on to objective test question number 4. You are provided with three statements, and you have to answer which statements are correct. The first statement is the general level of interest rates is affected by investors' desire for a real return. And we understand the nominal rate, which is equal to the real rate times the inflation rate. And here, the general level of interest rates affected by investors' desire for real return. It means that because of the return, the R is the desire. The general level is affected by yes, is one of the key components in the formula. And next, market segmentation theory can explain King's discontinuities in the yield curve. And we have three theories. We have three theories in the interest rate discussion, including market segmentation theory, including liquidity preference theory, okay, including the pure expectation theory. So, for example, the pure expectation theory in general has no very strong influence on the interest rate level. And the important part here is about the liquidity preference, because with this liquidity preference theory, and it holds, then a lot of the yield curve, the case is an upward sloping yield curve, because the people just would like to compensate their the loss of liquidity with the long-term deposit. So in other words, they were asking for higher return. It's explainable and acceptable. And here, market segmentation theory, yes, it explains the lackings in the yield curve, because in sometimes market segments, in particular segment, for example, in the short-term rate, those participants may expect the short-term rate will increase significantly, and may be caused by some short-term factors or reason in affecting the interest rate in the short term. So in other words, market segmentation theory can explain the kinks. The kinks means this discontinue. And here, for example, the yield curve, normal yield curve is an upward sloping, and when it has a kink like this, okay, here in this part is kink, discontinuity, maybe, or suddenly is a kink. Okay, here's a kink. Okay, here suddenly stop. And the third one, when interest rates are expected to fall, the yield curve could be sloping downwards. It's also true, okay? Because in normal case, the interest rate is going up and expected to going upward, and the yield curve should be just sloping upwards as well. But if it is expected the interest rate will fall sharply, then the yield curve will show it well before the announcement of the change in interest rate. So the answer here is D. All of these three statements are correct. Here, the question 5. Let's look at these questions, which statements are correct here. Interest rate options allow the buyer to take advantage of favorable interest rates movements. Is it correct? Yes, options is an obligation, is a right. but not obligation. So in other words, the buyer can take advantage or just leave it if it is not an advantage to him or her. So what he do is to just pay the options premium to take advantage of any favorable interest rate movement. So it's correct. And second, a FRA or a forward rate agreement does not allow a borrower to benefit from a decrease in interest rate. Okay, here, no matter it's forward or future, okay, once you go into this position, you are hedging your current positions. For example, if you have a receipt in 6 months time, so what's your risk is the foreign currency. Here's the forex. The foreign currency is dropped. Okay, it's your risk because you don't know now what's the exchange rate in 6 months time, and you are not in good position if the exchange rate is dropped or worse than what you are doing now. So here, for the forward or future, you use these instruments to compensate your loss in the cash position. So there is a cash position and a forward position. If your cash position is lost, you will have a gain in forward position, which can to compensate or to help you from the loss position in the cash position. But if you make gain in cash position, in other words, the foreign exchange rate increased, so you change more in 6 months time to local currency because the exchange rate is favorable to you. But here for the forward, if you go into forward hedge, the forward is loss making. Okay, so even you make profit in your cash position, but you are making loss in your forward position. So it cannot give you an option. You have to suffer from the loss. And if a borrower, he or she would like to enjoy the low interest rate, but if there's a forward rate agreement, in other words, it means you have locked the rate already, you have to pay at the agreed rate. So it's correct that does not allow a borrower to benefit from any downward or decrease in the interest rate. For the third statement, the borrowers hedging against an interest rate increase will buy interest rate futures now and sell them at a future date. It's not correct. It's not correct because the interest rate increase the bond price will decrease. Okay, it's the principle. If the interest rate increase, the bond price in future will be decreased. And you buy interest rate futures, it means you buy any bonds futures as well. So in this case, if you would like, your borrowers would like to hedge for any increase in interest rate, he or she has to sell futures now. Sell interest futures now. And buy them back at the future date. Otherwise, you cannot hedge your interest rate risk as a borrower. So it's not correct. The option here is only option A is correct. Next question. An investor plans to exchange $1,000 into euros now, invest the resulting euros for 12 months, and and then exchange the euros back into dollars at the end of the 12-month period. The spot exchange rate is 1.415 per $1, and the euro interest rate is 2% per annum. The dollar interest rate is 1.8% per year. And your requirement is to compare to making the dollar investments for 12 months, and what 12-month forward exchange rate will be investor make either a loss or a gain. So let's check. So the question here is we have to work on the forward exchange rate by the interest rate parity theory. Interest rate, IRPT. We learned that the forward rate, the current forward rate, will be the current spot rate times country interest rate of country B divided by 1 plus country C interest rate. So here what we know now is the S0, which is 1.415 times the euro interest rate, which is 2%, and the dollar interest rate is only 1.8%. Okay, so here's the per annum, and then you work it on a forward rate, which is making the investor neither loss nor gain. Which is the F0 is 1.4178 or 1.418. So the answer is C.